Gold and Bitcoin have been doing particularly well recently. Last week we looked at Bitcoin income funds, and this week it's gold's turn to shine. IGLD yields 7.3% paid monthly and offers exposure to gold's appreciation or depreciation. If you're looking for income that's not tied to the stock market, the US dollar, or tariffs, this episode might be for you. You know what's better than Google, ChatGPT, or investment websites? A community with a shared interest. I recently searched for gold funds that produce consistent income, but I didn't find anything that I like. Then I shared that experience a couple of weeks ago and learned something new. Viewers suggested several additional funds, including IGLD and GLDI. I dug deeper, and it's time to share what I learned. But perhaps the real lesson here is that sometimes the gold is in the comments. The IGLD distribution history is consistent except for one giant special distribution from December 2024. I was unable to find a breakdown of why that distribution was so huge, which is odd. If it was my fund, I'd explain this ridiculously high payout on the homepage or a press release, probably social media posts, but I'm just a lonely investor. I'll assume 2024 was an unusually profitable year, and they distributed the excess gains at year-end. Putting aside that abnormal distribution, we can see a pattern of growth. Distributions grew from 5 cents to 13 cents since the 2021 inception. One of the comments mentioned a yield of almost 20%. That's because most websites are currently showing a yield in the 17s because of that huge special distribution. I'm being more conservative and excluding the special distributions, so I took the past 12 regular distributions, averaged them multiplied by 12, and divided by the current price of $21.84, which equated to a yield of 7.3%. Compared to IGLD, the similarly named GLDI, the I is at the end instead of the beginning, GLDI is an example of inconsistent income. From 3 cents all the way up to $4.68 is a huge variation. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial. And if you're watching this between May 12th and 21st, 2025, they're running a summer sale. The link in the description connects you to the current Snowball promotion or the Armchair income discount, whichever is greater. Before we wrap up on GLDI, I have one more issue with it. GLDI has been around much longer than IGLD. It goes all the way back to 2013. But look at the price trend. It's going the wrong way. This is an example of NAV erosion. So we'll focus on IGLD. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. The FT Vest Gold Strategy Target Income ETF, ticker IGLD, uses options to produce 2 outcomes. Number 1, exposure to the price movement of gold, and number 2, income, as we've already seen. Understanding the options is important because this fund does not own any physical gold. The primary assets are US Treasuries. It uses these as collateral to back its option trades. The exposure to the price of gold is achieved by selling puts and buying calls on another fund, ticker GLD, because GLD tracks the price of gold. GLD is the largest ETF in the world that's backed by physical gold. It has $100 billion of assets under management. Of course, gold doesn't produce income, and neither does the GLD fund. If we look at the IGLD holdings, there are just 4 items plus cash. The puts and calls match each other in terms of number of contracts, strike price, and date, so they cancel each other out, with one exception. Their net value moves up and down with the price of GLD, which in turn moves up and down with the price of gold. Simple. This is also known as a synthetic position. Next, we'll look at income. That's created by selling calls on GLD. This results in monthly income in exchange for giving away the right to some of the potential upside of GLD. For example, as I record this, GLD is priced at almost $307. They sold calls with a strike price of just under $304. When those calls expire on May 30th, if GLD is still priced above $303.77, the fund will not benefit from any gains above that number. It's important to note that this does not apply to the entire portfolio. As of the end of April, it applied to 29% of the portfolio. The other 71% was free to appreciate or depreciate with the price of GLD/gold. The fund's objective is for this income to equate to short-term Treasuries plus 3.85% before fees and expenses. There's no leverage, no interest expense, and the expense ratio is 0.85%, which I assume is close to or equal to the management fee. Pretty simple. The tax, though, not as simple. As with many funds, tax treatment is not explained on the website. That's probably because it changes every year, so they don't want to make any promises they can't keep. I went through their 2024 tax year statement, and the income was 82% ordinary income, nothing special there. The other 18% was non-dividend distributions, which, in my experience, usually means return of capital. I'm not an accountant, only rely on advice from a tax professional. The confusing part is if you look at the 19A1 statements issued monthly, they show a very high percentage of return of capital. 19A1 statements are only estimates, and therefore I don't rely upon them. I only believe official financial statements and tax filings like this one. Apart from the yield, here's what I like about IGLD. If we look at total returns since IGLD was launched, it's slightly ahead of the S&P 500. What I like about gold and IGLD is that these two lines don't blindly follow each other. Sometimes gold is ahead, like right now, and other times, actually most of the time, stocks are ahead. The point is that I want income streams from a variety of investments that are exposed to different risks. That way, if something goes wrong, the entire portfolio, more importantly, the entire income stream, isn't affected. There's also an argument that gold reacts well to interest rate cuts. Despite some historical patterns to support that theory, I'm not totally convinced of this one. If you want to read more about the relationship between rates and gold, Macrotips Trading covered it in their analysis of IGLD on Seeking Alpha. I'll include a link to the article in the description and a link for a free trial and a discount. I don't buy or sell any stock or fund without first checking at least a few articles on Seeking Alpha. Here are the risks and concerns I have about IGLD. You could argue that now, when gold is hot, is the worst time to buy a gold fund. This is the history of gold pricing over the past 110 years. The current spike is obviously huge. What struck me about gold's long-term history is that the price moves in cycles that can last much longer than stocks. If you bought gold in 1980 and sat on it for 25 years, you lost a lot of money. If you bought gold in 2011 or 2012 and sat on it for 8 years, you lost money. IGLD has roughly the same downside as gold, so the negative is that it could decline for many years, much longer than a stock market correction. As with any covered call fund, if the value of the underlying asset declines over the long term, so too will the income. That's because the income is a percentage of the current value of the underlying asset, not what you paid for it in the past. There's a price to pay for receiving monthly cash into your brokerage account. As with any covered call fund, it will underperform the underlying asset, in this case gold, over the long term. That's because the upside is capped and the downside is not capped. So if you're a fan of gold and you want to sell it for profit when it's high and buy it when it's low, you could potentially make a higher return than buying IGLD. This total return chart shows the difference between IGLD and gold as represented by GLD. We can see that the two tracked each other closely for a couple of years, but when gold spikes, it outperforms the income fund. Here's a quick take on the other funds I looked at. GGN has 5 more cuts in its distribution history than I would like to see. GDXY is a year old, and despite offering a huge yield, I'm not a fan because the price has fallen almost 17% in a year when gold is on fire. When the price of gold falls again, which it will one day, I'm concerned that this one will get hit particularly hard. As we saw earlier in this episode, GLDI offers less consistent income and a negative price trend. NEOS has filed a registration to launch a gold ETF. Based on that filing, it will compete directly with IGLD, at least that's my interpretation of it. I'll keep an eye out for that one. Even though I'm not a gold bug, I like the diversification away from stocks, interest rates, credit risk, the US dollar, tariffs, and even Bitcoin. We can see that over the past year, gold, Bitcoin, and the S&P 500 have not moved in sync, which makes them all useful for diversification. Gold does its own thing, and IGLD offers a way to tap into that while delivering monthly income. I plan to start a position in IGLD in the coming weeks, and depending on when you watch this video, that may have already happened. I'll update any changes via Armchair Insider. If you're curious about Bitcoin income funds, they're a lot more volatile than IGLD, which is a negative, but they compensate you for that volatility with at least triple the yield. Click here to learn about my 2 favorite ones. That wraps it up for this look at IGLD. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.